Let's not forget, back in 1980, and we're talking here 45 years ago, silver was at one point, very briefly, at $50 an ounce. And that was because the Hunt brothers had come to the conclusion that the fiat system was going to die and they wanted to buy as much silver as they possibly could. And the gold price was also at an all-time record at that time. It was at $850. So that put the ratio of gold to silver, or silver to gold, at 17 to 1. In other words, 17 ounces of silver bought you an ounce of gold.
Right.
Well, gold today is, let's call it $3,400. So silver would need to be $200 an ounce if we got back to that ratio.
In 1980, silver reached a peak of $50 per ounce, while gold climbed to $850, establishing a historic gold-to-silver ratio of 17 to 1. According to senior analyst Clive Thompson, applying that same ratio to today's gold price of around $3,400 would suggest a silver price of approximately $200 per ounce. While silver remains far from that mark, recent price action has reignited interest in the metal. On Thursday morning, silver futures surged as high as $36.27 per troy ounce, marking the highest level in more than a decade. This represents a significant milestone, as silver has not seen such levels since early 2012. So far in 2025, silver has gained more than 20% year-to-date, confirming its status as a strong performer among commodities. However, gold continues to outpace silver, rising about 28% this year. With gold prices easing slightly on Thursday, silver's continued rally narrowed the gap between the two metals, particularly in terms of their relative value. The recent price surge also had a noticeable impact on the gold-to-silver ratio, a simple metric used to compare the relative value of the two metals. The ratio has now dropped toward 94. A sharp move from the post-COVID highs above 100, when gold hit its record of $3,500 in late April. This drop indicates silver's recent outperformance relative to gold, reflecting renewed investor enthusiasm. Clive Thompson notes that many investors had been waiting for silver to break out above key resistance levels, and with the move above $36, fresh buying interest appears to be emerging. He suggests that this momentum could push silver even higher in the near term, though it's difficult to predict where the next pause might occur. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Yes, it's going to go higher. I think we've broken $35. That was the number that almost every analyst had on their radar screen. They were saying, if it goes to $35, I'm loading up. And so I think a lot of people will be diving in. So it wouldn't surprise me if we go past $36 today. And then I think it's probably plain sailing till we get past 30. At what point do we get a pause? Nobody knows. It might just keep going. Let's not forget, back in 1980, and we're talking here 45 years ago, silver was at one point, very briefly, at $50 an ounce. And that was because the Hunt brothers had come to the conclusion that the fiat system was going to die and they wanted to buy as much silver as they possibly could. And the gold price was also at an all-time record at that time. It was at $850. So that put the ratio of gold to silver, or silver to gold, at 17 to 1. In other words, 17 ounces of silver bought you an ounce of gold.
Right.
Well, gold today is, let's call it $3,400. So silver would need to be $200 an ounce if we got back to that ratio. There is maybe the bad thing for bulls is there's a lot of above ground silver knocking around just waiting for its price, especially, in coins and bars and knives and forks and candlesticks and God knows what else. And of course, there's plenty of warehouse stocks too. All of it's waiting for its own price. But I think that can easily get overwhelmed by the precious metal buyers.
Right.
And it would do in particular if we have any sort of hiccup or pause in the stock markets. We saw a month or so ago when the tariffs were announced, the stock market took a very heavy dip, and it was almost down to bear territory, which is minus 20%. Didn't quite get there, and it rebounded. And I think a lot of us thought it was a dead cat bounce, but now it seems to be powering ahead, and maybe we're going to go to all-time highs again. But let's say we do get some sort of hiccup in the stock market, people will be looking at that point around for something which hasn't really risen as much. And of course, gold and silver, and particularly silver, are way down in the dumps from their all-time highs. Well, not gold, but silver is way down in the dumps from its all-time highs. And I think there might be some money going in that direction. But what happens if it pauses? Well, it doesn't change the fundamentals of silver. We know that according to the Silver Institute, that the supply of silver coming out of silver mines has been diminishing year on year. And since a few years, the industrial demand and usage of silver has exceeded the supply such that the deficit is getting larger. And the way that deficit has been filled has been by recycling. But we've seen the price, it had to go higher. It's gone roughly from $20 to $30, we're $35 now. The prices had to rise to suck out that recycled silver. But I can tell you one thing. I deal with a silver and gold dealer here near where I live in Geneva, and they used to have a lot at $20 and $25 and even $30. They used to have a lot of silver for sale. People were bringing in their coins and so forth because they were disillusioned. Now that supply of stuff coming in has dropped down to a trickle, so much so that they now hardly ever call me. And they know I'm a ready buyer. If they call me and say we've got something in, I'm going to go along and buy it. Right. They're not calling. Why are they not calling? Because they don't have it. To be honest with you, I trust gold more, but I think the bigger gains will come from silver. And I won't exclude platinum as a precious metal as well. But again, it's not a situation where you want to be all in on anything. You don't want to be all in on gold or all in on precious metals for that matter. Right. You need to be diversified in a lot of things. But the one thing I think you need to avoid, or I would say avoid, you need to be aware of is if you have holdings in cash and bonds, you're going to be going backwards as far out as the eye can see, and you're going to end up at some point regretting that you held these things. Now, at the moment, it doesn't seem to be too dangerous to hold cash or bonds because perhaps only if we take the rate of expansion of government debt and money supply together, we're probably expanding at a rate of 7%. That will accelerate, by the way, right. But we're probably expanding at 7%, and you've got an inflation rate of maybe, it depends whether you're looking at the stuff made by robots or whether you're looking at the stuff you might spend your money on when you retire. If there's different inflation rates. So I would like to suggest the stuff you might spend your money on when you retire is probably also increasing by 7 or 8% a year. Nursing homes, luxury cruises, having the sort of luxuries that you'd like to have around your home, paying right. Your grandchildren's school fees, whatever it is. So if you have cash and you've got an inflation rate of 7 and you're earning after tax maybe 4 or 3%, you're going backwards by several percent a year. Absolutely. Your buying power is going backwards. So going backwards by 3 or 4% a year isn't that bad a price to pay for the peace of mind. So many people say, I don't mind that I'm going backwards. At least it's there. I can count it. I can see it in the bank. And I don't want to, I'd get far more stressed if I put my money into the stock market or Bitcoin or gold or silver where the price changes on me every day. I wouldn't feel comfortable with that. And I don't want to buy a property for this reason or that reason. So there are plenty of people out there who quite justifiably say cash is a good thing. And for the mental state, it is a good thing, provided that the rate of depreciation is only a few percent a year, 3 or 4%. But unfortunately for them, that's going to accelerate and their thinking is going to change. And as it changes, they will be looking for other things to invest in.
Donald Trump's proposed signature tax bill is projected to add $2.4 trillion to the U.S. national debt over the next decade, according to a new analysis by the nonpartisan Congressional Budget Office. The bill, often referred to by Trump as One Big Beautiful Bill, is estimated to reduce federal revenues by $3.67 trillion while only offsetting $1.25 trillion in spending cuts through 2034. The analysis comes at a time when America's national debt has already reached a staggering $36 trillion. The fiscal strain highlighted in the report adds urgency to warnings from Treasury Secretary Scott Price-Besant, who stated that Congress must raise the debt ceiling by mid-July to avoid a potential default. The Treasury Department has signaled that it may need to employ extraordinary measures to continue meeting the government's financial obligations on its $30 trillion of outstanding debt, according to The Hill. Clive Thompson, a senior financial analyst, noted that the U.S. technically hit its debt ceiling earlier this year and has since been relying on temporary stopgaps. A new proposal now under consideration seeks to eliminate the debt ceiling. While such a move would remove the recurring threat of government defaults and political standoffs, it also introduces new risks. Investors are increasingly wary that lifting all borrowing limits could accelerate debt accumulation and flood the market with Treasury securities, potentially raising borrowing costs and undermining confidence in U.S. fiscal stability. Let's get back to the interview.
The plan that they have, or the preferred plan, I suppose, is to keep borrowing money from Peter to pay Paul and hoping that that doesn't cause the yield to rise. Right. But, of course, the yield will rise because Peter is getting indigestion because the level of government debt is rising at a much faster rate than the rise in GDP. So to bring things back into balance, we either need a very big rise in GDP, perhaps to the order of 7%, or we need a large fall in government spending and a rise in taxes. And I don't think there's a lot of enthusiasm for either. I mean, we've seen this bill from the president, in which it's proposed that the tax cuts, which were due to come to an end at the end of this year, will carry on for many years.
Right.
That's not part, at the moment, the Congressional Budget Office have not got that in their budget, but it will add roughly $500 billion a year to the deficit. But as it stands without that, according to the Congressional Budget Office, the level of debt over the next decade is going to go from 100% of GDP to 150% of GDP. It's a huge rise in the level of debt. And that's with maybe some rather conservative figures from the CBO. They're assuming there's no wars, no pandemics, no recessions, no sudden crisis. But history says something goes wrong all the time. No banking crisis. Yeah, who knows what will go wrong? But according to the CBO, they've set out their numbers for the next decade, and they assume that nothing will go wrong. And also they assume, and I think this is wrong, to assume it, but they've assumed that interest rates will be about 2.8% rising to 3.3%. Well, we know that a lot of the government debt is at that sort of rate for historical reasons, but it's maturing, and as it matures, it has to be rolled over at a much higher rate, because the rates at the moment at the short end is 4.6% or over 4%, and at the longer end it's going up to nearly almost on 5%. So unless those rates come down, and I'll tell you why they won't in a second, unless those rates come down, the rate of interest that the CBO has put into their budget projections of 3.3 in the long run aren't going to be hold true, and therefore the government will be having a bigger deficit than they're forecasting just on interest rate grounds alone. At the moment, we've got a debt ceiling in the United States since the 2nd of January this year, which means to pay the bills, the government has been basically not borrowing big one, it can't borrow, it's been running down its cash balance, and it's been withholding payments to the government pension plans.
Right.
And it'll make those pension plans whole with interest when the debt ceiling is raised. And I think yesterday or today, our president has proposed that they get not only raise the debt ceiling, but they get rid of it completely, so there is no debt ceiling ever again. Well, that's okay. I mean, that most countries don't have a debt ceiling, so America's kind of an exception by having one. But from an investor in Treasury bonds, it maybe was some sort of comfort to the investors in Treasury bonds that there's at least up to a point, there's a limit as to how much they can borrow. But if they get rid of the debt ceiling completely, there'll be no limit, and that of course means that the supply of treasuries can increase faster and faster as they spend their way to keep the economy rolling along. Obviously, it's very good for the holders of assets like gold, silver, property, equities, Bitcoin, or works of art or heirlooms, anything which people want to own. It'll be very good for that, for the people who've got those things. But for those people who are saving in money terms, well, they'll be going backwards at a faster rate. Just to tell you for the deficit for the current year, now these are my figures, but I've extrapolated them from the Congressional Budget Office's own numbers. In the current year, we're going to have a deficit of $2.19 trillion, 2.1 or $2.2 trillion. That is the highest ever, is because the tax receipts this year are up 4.9% or nearly 5%. Very good. That's in this fiscal year. But the spending this fiscal year so far is running at the rate of 8.9 or 9% higher than the year before. So putting those two together mean that the deficit will be 22.6% higher than it was last year.
As silver breaks through decade-long barriers and gains traction against gold, its revival signals more than just speculative enthusiasm. With mounting debt concerns and fiscal policies casting shadows over traditional safe haven, investors are reevaluating their strategies. In this recalibrated environment, silver is not just riding gold's coattails, but carving out its own space as both an industrial asset and a monetary hedge. Meanwhile, rising national liabilities and legislative proposals aimed at reshaping borrowing frameworks introduce new layers of complexity to the economic outlook. Could the current fiscal trajectory and policy experimentation serve as a catalyst for a long-term shift toward alternative stores of value, such as silver? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.